The best trade in the world at this phase, the next 2 to 3 months. At the end of this phase, I think the Fed come with their cannons again. Whether it happens quickly or in 3 or 6 months' time, it's coming, and the markets will start to the Pavlovian response of the cavalry's coming. And then I think it's very positive for things like cryptocurrency, probably gold, and a few other things. Real estate, I think, is going to take a while, but I don't think it's probably a big event. It got very frothy. It probably corrects somewhat. But again, I don't think the Fed or anybody else wants to see the property market go down because everyone's got the learnings from 2008. So yes, it softens a bit, etc. I think it's okay, and you'll probably get some bargains.
Faced with the highest inflation in more than 40 years, the Federal Reserve has once again turned up the heat, taking its most aggressive step yet in an attempt to curb inflation. The Federal Open Market Committee unanimously decided to raise the target range for the federal funds rate to 1.5 to 1.75, with further rate hikes looking inevitable. The 75 basis point hike follows an already aggressive 50 basis point increase in May 2022 and marks the largest upward step since 1994. In today's video, CEO of Real Vision and global macro investor Raoul updates about US Fed's decision of raising interest rates to fight 40-year high inflation and its impact on cryptocurrencies like Bitcoin, bonds, equities, and stock market. He also reveals important information about the timing of a recession and what the Fed will have to do to keep the economy from dropping into a depression. Make sure to stick around to the end of this video where Raoul explains why most experts are wrong about the economy.
What choice do you give people? Do you say, well, you're going to get destroyed because of the supply chain issues, because of COVID and all of this, and your wages won't keep up, so we're going to destroy household net worth, and everything's levered. So all the borrowings against houses and all the borrowings against equities and all of the borrowings on top of borrowings, and you're going to let the collateral go down and blow the entire thing up?
When the Federal Reserve raised interest rates last week by the largest amount since 1994, it did more than declare war on inflation. The U.S. Central Bank also launched a high-stakes test of the economy's ability to shed its dependence on limitless credit and tolerate higher borrowing costs for consumers, businesses, and the government.
Yeah, because don't forget, the abasement of currency works in a simple way. If you're really thirsty and I have a bottle of water, you'll pay anything for it. If you're really thirsty and I've got 5 bottles of water, you're kind of thinking, yeah, I probably need some of that water. I'll buy them all, but at a lower price. If I say, here's 1 million bottles of water, you don't want any of it because there's too much water now. It has no scarcity. So if you make too much of something, it becomes less valuable. So if Da Vinci had created 50 million pieces of art, guess what? They're worthless. And so it's that concept. And what it does is if something gets devalued versus something else, so we're not making more shares in the S&P. Actually, what we're doing is buying them back, making less of them. Therefore, the S&P goes up. Real estate. Yes, there's periods where we try and create new real estate, but generally real estate prices go up versus the Fed balance sheet because it's a relatively scarce asset. Same with gold, same with crypto. And we either go through a scenario like 2000, which was a typical old school recession where, equity markets, unwound excesses, the bear market was 18 months or so, and then the Fed keep cutting rates and eventually it stabilizes. But if we look at 2008, which was the next recession, as soon as the Fed used the Fed balance sheet, we pretty much stopped in its tracks. Happened really quite quick after they did that. They cut rates first, didn't really help because the banks had seized up. Then they used the balance sheet. Then they did it again in 2010, 12, 16, and then 18 was the Fed pivot, the Powell pivot, where they went from hiking to, oh my God, we need to cut.
Whenever the stock market wobbled, beginning with the 1987 crash, the Fed rode to the rescue by slashing rates and flooding markets with cash.
Anyway, the point being is you either have a fiscal stimulus, which is, let's say, the Republican view. We'll have a fiscal stimulus, cut taxes. And we'll put some spending. And what happens is is that doesn't go to the people who are the worst off.
Right.
So it's creating this issue of 1% versus 99, which everybody can see and nobody knows how to solve. The issue is actually the balance sheet, because all of the expensive assets keep going up because they keep printing money.
The rich get richer.
The rich get richer.
Yeah.
But doing this blanket fiscal stimulus is hard because the rich get richer again. So I think people have thought, well, maybe we should just try and give it directly to the people who are most affected. Okay, fine. Those are the two choices, or you do nothing, which is too late because there's too much debt. So you can't let the system clear anymore. The old way would have been you let the system clear, it's all okay, you just have a recession, everyone stops borrowing as much money, blah, 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 blah. The world is 400% of GDP in debt. The world has never been this in debt in all economic history. Yeah, it's the fourth turning.
Right, okay.
It's the fourth turning, and that's where we are. And this may be the final event of the fourth turning. It may be just another phase of pushing this towards it. 2001, 2008, 2020, and maybe now. It just keeps moving the world to the direction that we all know it has to go. Is we need to stop what we're doing and change what we're doing.
The Fed's 0.75 percentage point increase in its benchmark lending rate last week marked an abrupt end to more than 4 decades of falling and ultimately near zero interest rates. The shift has rocked financial markets, driving mortgage rates to their highest level in nearly 14 years, sending bonds into their steepest plunge ever, and tanking speculative investments such as technology stocks and Bitcoin, a cryptocurrency.
I always say the bond market is the truth. The bond market, the job of bond market participants is 2 things only. What is the future rate of inflation, and what's economic growth? Now, in the stock market, it's like earnings and this and emotion and all of that. The bond market is simply 2 things. So they usually get it right. And the easiest way to look at it for most people is TLT. TLT is the bond ETF. If that starts rallying, which it's been doing strongly, before it was going down when the stock market was going down because everyone was fearing inflation. It's just switched. So bonds are now going up when the stock market goes down, which tells you the bond market's going, okay, enough's enough, guys. You've gone too far.
As the economy adjusts, more tumultuous lies ahead. Consumers are already feeling the pinch of higher prices, and they will pay for more credit card balances and auto loans. The least creditworthy companies will struggle to raise money needed to hire and expand.
Because if we're right here, and you got cash, and we're going to see this big whoosh, and it probably means that the economy and asset prices, there's certain things it's going to set up for, right? We were talking off air about, okay, the opportunity to buy cryptocurrency into this sell-off. Yes, because it is the technology of the future. It also protects against this debasement. We will see, let's say, technology equities, things like genetic sciences and AI and all of this stuff that's coming. It's coming faster than we can ever imagine. Most of this stuff is down 80%. I mean, hell yes. This is what we're looking for. If you want to generate wealth, this is the time to step up.
Yeah, this is the best time.
And you might have the ability to own both commodity stocks because the supply issues are still around for a while. Commodity stocks and technology at the same time, which a lot of people think is weird. It's like you need to be one or the other, and they have this warfare over it. I think both will work quite well as a barbell strategy.
The federal government, which spent freely during the pandemic, will also feel the sting of higher rates. Annual interest on the national debt will reach $399 billion this year, according to the Congressional Budget Office. But that estimate assumes that the government will pay 2.1% to borrow money from long-term bond investors. If instead the yield on the 10-year Treasury security this year averages its current 3.25% figure, taxpayers would pay an additional $32 billion in interest, according to the Nonpartisan Committee for a Responsible Federal Budget.
It is so important for people to get the right education. It is imperative. And there are lots of kind of scams around education. And we wanted to democratize the same kind of quality of financial education that we've done with financial information. You guys watch Real Vision, you know the quality. And it's not, I can't fully announce what we're doing, but we're really going to change the game on what it is, because these things cost fortunes, thousands for a good course, it's thousands of dollars. Most of them are not even done by people who've been in the markets. but we're going to change everything and create something nobody's ever done before.
Now, the Fed projects its policy rate in the long run will hover at 2.5%, a level it has not been able to hold consistently since the 2008 crisis. So, what do you think will be the ultimate impact of Fed's policy of raising rates? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video, and thanks so much for watching.